Welcome to The Explainer. You know, we love taking complicated stuff and making it simple. And today, we're going to try and decode the secret language of the financial markets. I mean, it's the million-dollar question, right? And look, nobody has a crystal ball, but a lot of traders, they believe the market actually whispers its secrets through its own history. The art of listening to those whispers? Well, that's what we call technical analysis.
So really, at its heart, technical analysis is just a toolkit. It's for trying to understand the psychology of the market, that collective fear and greed that pushes prices all over the place. It's not about predicting the future with 100% certainty, not at all. It's more about stacking the probabilities in your favor. So come on, let's open this toolkit up and see what we've got.
All right, first things first. The most basic, fundamental question any trader is going to ask is super simple. Which way is this thing heading? Are we going up, down, or just sideways? Okay, so let's start with support. Just think of it like a floor. It's a price level where in the past a bunch of buyers have jumped in thinking, hey, this is a great deal. And that rush of demand basically stops the price from falling any further.
And on the flip side, you've got resistance. That's the ceiling. It's that point where sellers usually start cashing out, and that puts a lid on how high the price can go. Now here's the really important part. The more times the price bangs its head against that ceiling or bounces off that floor without breaking through, the stronger those levels get. And what's super cool is when a ceiling finally gets smashed, it often turns into the new floor.
So to get a feel for the market's general direction, traders use something called moving averages. The best way to think about them is that they smooth out all those crazy, choppy, day-to-day price swings so you can see the underlying tide. The simple moving average, or SMA, that one's like a slow, steady tide. It gives you a nice long-term view. But the exponential moving average, the EMA, that one's way more responsive to what's happening right now. But you gotta be careful, because sometimes it can trick you and pull you into a little fake out.
Okay, so how do you actually use these lines on a chart? It's pretty straightforward, actually. If the price is kind of surfing on top of the moving average line, you're probably in an uptrend. If it's diving below it, well, you're in a downtrend. And you really want to watch for something called a crossover. That's when a shorter-term average crosses over a longer-term one. It can be a massive signal that the whole trend is about to change direction.
All right, so moving averages give us the direction of the tide. But that's only half the battle, right? We also need to know how strong that trend is. Is it a massive, powerful wave, or is it just kind of losing steam and about to fizzle out on the beach?
And for that, we've got these cool tools called oscillators. Honestly, just think of them as the market speedometer. They bounce back and forth between different levels and tell you if things are getting overbought, going too fast, or oversold, slowing way down. It gives you a real-time feel for the market's momentum.
Yeah, and one of the most famous oscillators out there is the Relative Strength Index, the RSI. Now, when this thing climbs up above 70, it's like a little warning light flashing on your dashboard. It's basically saying, hey, the buyers might be getting tired here, and a pullback could be right around the corner.
And you guessed it, the opposite is also true. When the RSI drops below 30, it suggests the market is oversold. It's a sign that the sellers have maybe pushed things a little too far too fast, and the selling pressure is running out of gas. A bounce could be coming.
Okay, now this is where it gets really, really cool. What happens when the price on the chart is doing one thing, but your little speedometer is telling you something completely different? Well, that's called divergence. And let me tell you, it is one of the most powerful signals a trader can look for. So many people miss this.
So picture this. The price of an asset hits a brand new high, but at the same time, the indicator is actually making a lower high. That's a classic bearish divergence. It's a massive red flag that the upward trend might be running out of juice. But then you've got this other thing, hidden divergence, which is a bit sneakier. It can actually signal that the trend is just taking a little break before it continues on its way.
Okay, so we've got direction, we've got momentum. Now, let's talk about patterns. We're going to look at how all that pushing and pulling between buyers and sellers actually creates these recognizable shapes on the chart. Think of them like footprints left behind by the crowd. And for this, Bollinger Bands are just a fantastic tool. Picture the price as a river flowing along. The Bollinger Bands are the river banks. When the banks are close together, the river is calm and quiet. But when those banks start to widen out, whoa, that means the river is raging and volatility is picking up big time. Now, in a market that's just kind of drifting sideways, not really trending up or down, these bands can act like moving support and resistance. A really common strategy is called the Bollinger Bounce.
Traders will watch for the price to hit the top band and then sell, or hit the bottom band and then buy, basically betting that the price is going to snap back toward the middle.
But when those bands get super, super narrow, you got to pay attention. That's what's called a Bollinger Squeeze. It's like a coiled spring. It's the market telling you that this period of calm is about to end with a huge, explosive move. The only question is, which way is it going to go?
So, beyond just lines and oscillators, traders are always on the lookout for these classic chart patterns. These shapes are literally a picture of the battle between buyers and sellers. You've got reversal patterns like the famous head and shoulders, which signal a trend is about to turn around. And then you have continuation patterns like flags or pennants, which are more like a brief pause before the trend gets going again.
And then you've got these in-between patterns, like triangles. A symmetrical triangle, for example, shows that both buyers and sellers are digging in their heels. Nobody's in control. The price just gets squeezed tighter and tighter until the point of the triangle, until, bam! One side finally breaks and the price explodes out.
Okay, so we've got direction, we've got momentum, we've got patterns, we have all these tools. The big question is, how do we put it all together to actually make sense of the market?
Well, it's absolutely crucial to understand that not all these indicators do the same thing. You've got leading indicators, like the RSI we talked about. Think of them like scouts, trying to see what's coming over the next hill. Then you have lagging indicators, like moving averages. They're more like historians, confirming what has already happened.
And that brings us to maybe the golden rule of all of this. No single indicator is a magic crystal ball. It just doesn't exist. The real power comes from confirmation. A good analyst acts like a detective. They're looking for multiple clues that all point in the same direction. So yeah, a bullish signal on one indicator is interesting. But when that happens right as the price bounces off a major support level, now that's a case you can build. And this right here just shows you exactly why you need a bunch of different tools in your toolkit. Because, and this might surprise you, markets don't actually trend most of the time. Nope. They actually just chop around sideways, in a range, something like 70 to 80% of the time. And different tools work in different market conditions, so you have to know what kind of market you're dealing with.
And all of this leaves us with one last, kind of mind-bending question. When you have millions of traders all over the world, all looking at the same charts, drawing the same support and resistance lines, and seeing the same patterns, do these things work because there's some kind of magic? Or do they work because they become a giant self-fulfilling prophecy? You know, the price bounces because everyone expects it to bounce. Now that is something to chew on.